Shalom and good evening. Thank you for joining us. My name is Josh Sussman from the marketing and program team at Nefesh B'Nefesh. I'm very, very happy to be joined this evening by Moshe Wilshinsky from Mobile Mortgage and Finance, who has graciously given his time and will share his expertise with you. We also have another friend, colleague, and supporter of Nefesh B'Nefesh, Yair Givati, who is a Jerusalem-based real estate lawyer, who is on as well, who will be helping with Q&A. A couple little technical notes. Please put all of your questions in the Q&A section, not in the chat. Additionally, we don't use the raise your hand feature. So just if you have a question, do put it in the Q&A. This session is going to go for about 50 minutes recorded. If we have questions after that, I'm going to turn off the recording. I'm going to say goodbye and wrap it up. But we will then continue on and try to answer as many questions as we can for another 15, 20 minutes after that, as long as Moshe and Yair are willing to stick around. So with that, additionally, this is being recorded, and I will send out a follow-up email tomorrow or the next day with a recording, along with the presentation itself and any links or contact information that Moshe and Yair mentioned throughout the evening. Thank you very much, and I will pass it to Moshe.
Thank you very much, Josh. I'm really excited tonight, and we have a lot to go over. So I want to say up front that there's going to be a lot of information, and besides the recorded webinar, if anybody wants to email me for some specific tips, because we'll see that there's a lot of different conditions, but we'll have a lot to go over, so we might go a little fast, but don't worry, in the end, if you want, you can email me for particulars that might be pertinent to you. Tonight, we're going to be reviewing a few key points. And I think one of the most fundamental issues is a lot of people, whether they've gone through the mortgage process in the US or just by being exposed to the incredible amount of marketing and whatnot by the mortgage industry, are influenced by the way the mortgage process is there. And very often, the expectations they have are for the mortgage process here are influenced by that. So one of the things I want to do is I want to sort of set a realigned parameters of what you can expect here and what's available, as well as dispelling some fears that things you may have heard. And you'll see that the process here and the mortgage market here, albeit young, is evolving, and there are actually things here that you can't get in the US. Also, the idea of what you need to ask. One of the things we're going to see is that there's a major difference between the disclosure regulation and everything else that's done in the US versus what is done here. And lastly, it's just give you some context. So when you're ready to take your next step in the mortgage process, you'll know, or you'll have an idea of what you need to do. Asking questions. That is one of the most important things. And sometimes, again, because of perspective, people focus on issues that maybe aren't the factor, the most important factor that they should be looking at. So again, the parameters tonight, you'll see that there are a number of things that you should be concerned with and asking about. In particular, we're going to, as I said, realign perspectives and the criteria for mortgage. What does it take to get approved? And what do you have to do in the mortgage process? We're going to learn about the Bank of Israel. And the Bank of Israel is a Swiss Army knife of regulators. But for our concerns, we're going to learn about all the things they regulate in the mortgage industry. We're going to learn about one of the things that's unique in Israel versus the US, but a mortgage that has multiple parts to it, each one with different terms. As I mentioned, we're going to learn about the mortgage disclosure, types of interest. That is very important. Again, in the US, you have a type of interest. I'm not talking about the adjustable or fixed. We'll get into that. And insurances. So again, a fundamental difference is the US market is old, right? And we're going back, I say 1850s here, but it's really before. And since the 1960s, there's been active regulation across the board. Everybody from a secretary in a mortgage broker's office to a mortgage bank is licensed, goes through continuing education, et cetera. And there's a tremendous amount that goes into what has to be given to the consumer, as well as a secondary mortgage market that really expanded in the 80s. The Israeli mortgage market is young. I've actually been in the mortgage market 35 years, which is about 5 years before the banks actually started lending here, because before that, it was purely government funded. And it was only in 2010, we'll see as a result to the crash in 2008 around the world, that the Bank of Israel really started focusing on the mortgage regulations that most of us feel. Again, these are all things, if you've been through the mortgage process in the US, these are all aspects of what enables it to do what it does. But whereas the US is originating somewhere between $2 to $3 trillion on an annual basis, that's not the size of the portfolio, that's how much is made on an annual basis. In Israel, we're approximately 80 billion shekels, and we're young and still developing that infrastructure. So you have to keep in mind, there's a lot more that we'll see that's do-it-yourself here. Again, in the US, you either have a digital choice for a lot of things, but everything else, title, everything is brought to your door. You brought to your door, you don't touch the title transfer on your property or anything else. In Israel, lawyers like here have to work very, very hard. Lawyer here works much harder than if you're using a lawyer, if you're on the East Coast of the US, than what they have to do, because we'll see there is no title company. Everything here is basically the consumer, the borrower themselves, has to follow through, has to worry about getting things to the bank, et cetera. All these processes in the States are handled by third parties and usually managed by the bank for the consumer. One thing that doesn't exist in the States is that when you borrow in the States, you're borrowing all the money at the same term. So you have that $300,000. Every dollar has the same interest rate, as well as the same period of amortization. In Israel, the pie with three pieces is just one example. We'll see. There's many ways to do it. You could think of it. I was once told actually by one of the somebody in the original mortgage underwriting departments here in Israel, that internationally, the way he described it was a inverse investment portfolio. Qualification. This is the international language of qualification. Again, there's a regulation, Basel III, that's, just for some perspective, Basel II took about 18 years to come into actual effect. After 2008, they created Basel III in about 18 months. So Israel and all the other countries within the Organization of Economically Developed Countries, their regulators, in our case, the Bank of Israel, had to put in regulation that followed these things. So again, the A, B, and C is something that's always been looked at. You hear in the States talking about non-QM mortgages, right? Or that's for mortgages that can't qualify an income, but the basic issues hold true here, just like you have on a fully documented loan in the States with Fannie Mae, or your documented income to make sure you have the ability to pay, your credit history to make sure that you're willing to pay, right? And then C, your collateral, just in case they're wrong on A and B. So what are they looking to validate? Again, this is the mortgage bank, and they answer to the Bank of Israel, right? Because they can't, if they do a loan that's not within the regulation, it will cost them dearly. So they need to see that there's stable income, meaning it's consistent. It's not like you're making money this month and you don't make money for another 10 months. there is consistency in terms of the amount. The magic thing, the thing that they need to measure, the way the regulation determines, is the debt to income ratio. And just for an example, get into this a little more later on, somebody has a $1,000 mortgage payment, they have $3,000 of monthly net after-tax income. That's a 33% debt to income ratio. If you're familiar with these terms in the States you have a front-end ratio, a back-end ratio. And in the States, they use not only principal and interest, they use principal, interest, taxes, and insurance. Here, we're only principal and interest. The documentation they need to validate this, and I'm focusing on income because that's basically income and your down payment are the two major factors that determine what you can buy. For some people have both Israel income and US income. Some people only have one or the other. If you're a salaried employee, it's much simpler because it's in the US, your W-2, your 1040, and your pay stub. And in Israel, it's your tlush and your 106. If in addition to that, or in place of that, you either own a piece for all of the company that you work for, then the information on the company itself is required. If you have trust income or anything else, all those, whatever the entity is that's providing you income, those tax returns and the financial statements, balance sheets are all required. And ultimately, one way or another, there's either, if it's an Israeli account, Israeli income, there's a form each bank has that needs to be filled out for periods, whether it's the current period, meaning the year to date of the year, or the previous 2 years, needs to be filled out and signed by the accountant. In the US, it's a letter. Disclosure is one of the differences in practice. As I mentioned, all these regulations, truth in lending started in the 1960s, and it's been expanded and rewritten probably 20, 30 times over that period of time. The APR, annual percentage rate, is what requires how interest is described to a consumer so they understand it fully. Again, this has evolved over more than 60 years. In Israel, we are just beginning, right? So while we're starting with mortgage regulation, for example, in the US, you get quoted a mortgage, the regulation requires that from that quote, within 3 days, they have to have a signed disclosure from you that you've received the prerequisite explanations of what those interest rates means, et cetera, okay? Israel's just starting something with adjustable rate loans, but that's signed at the loan closing when you're actually signing loan documents. That's one example. The Bank of Israel, as we mentioned, they are the regulatory agency for many different areas. What's important to us is the residential mortgages, right? And they're also the one that's been responsible for the COVID leniencies. And for anybody that's been following it, they've been doing a pretty incredible job. So 2010 is when the mortgage regulation really came down, because before 2010, a lot of things that we're talking about, with from LTVs to the limitations on adjustable rate mortgages, et cetera, didn't exist the way they exist today. For example, while LTVs, loan to value ratios, did exist, there was insurance that allowed you to buy with a 95% loan to value, meaning you came down with 5%. So the Bank of Israel has been active in probably between 2010, 2015 is when most of the regulation came in. Some regulation came in after that. For the most part, until about 8 months ago, all the regulation that was introduced was always something that was more restrictive. Over the past really COVID period, there have been leniencies for the first time in well over a decade. Just a high level on the way they're regulating the income and that debt to income ratio is they're looking, again, it's that stabilized net after tax income. And the upper limit on that is 40%. If somebody has installment debt that is continuing beyond 24 months, that's going to need to be included as well. We'll see more on that later. The loan to values, the number of years also is now limited at 30 years. The use of adjustable rate interest within the mortgage, we'll see in the parts, that is also something that's been limited. It was actually just eased up. We'll see that in a bit. And prepayment penalty fees. All right, prepayment penalty fees are not the bank's choice. It is regulated by the Bank of Israel. LTV for a non-citizen is whatever you want, as long as it's 50% or less. That's for a non-Israeli citizen. For an Israeli citizen, they have a choice depending on the situation. If they're buying, and this is either their only property or they are committing to sell the property they have. So technically they do own two properties for a while. They can get up to 75% as long as they can meet the more stringent requirements for the approval. Now, if they are keeping their previous property, so they're buying a second property or they own multiple properties, their loan to value drops to a maximum of 50%. Again, they can cross collateralize, so that 50% could be more than one property. A cash out refinance today, and this is an example of a leniency, is a 70% loan to value. That means property is worth 1 million shekels, borrow up to a combined mortgage of 700,000 shekels. Pre-COVID, that was 50%. Now, we'll see there are situations where, depending where the property is located, the bank may reduce the loan to value to make up for their perceived risk of the title in that area. Now, while an Israeli citizen can get 75% loan to value, because of the regulation, the perceived risk is higher with the higher loan to value. So the same borrower, the same property, they could literally see 0.75% interest, depending on the market. It could be 0.6 to 1% between them basically taking a mortgage of 45% of the value versus them taking a mortgage that is 75% of the value. Same borrower, same property. So you understand how the loan to value is one of the key things that adjusts and affects the risk perception that the bank has to price upon based on the regulation. Value is very similar to the States, right? If you have a property and you're getting a great deal and it appraises for more than what you're buying it for, the bank is going to use your purchase price. It's the lower of the two. And the appraisal, again, like the US, after, again, this was a post 2008 financial crash regulation, that they want to make sure that your real estate broker, or somebody in the transaction is not best friends with the appraiser. So they're going to have automatically produce 3 names. You could choose one of those names to do the appraisal. The appraisers themselves they have a regulation they have to follow, and there are different types of appraisers. There's a short appraiser, there's a longer appraiser and appraisal, and then there's an appraisal that is let's say for certain construction, for more expensive properties, or for complicated title issues that requires a special appraiser. So it really depends the type of appraisal that they're using. And once you have an approval, and if you're purchasing a property, you have a purchase contract, the bank dictates what the appraiser can charge up to a certain limit. That could be 3 million or 4 million shekel, depending on the bank. And the price that you're going to get the appraisal for is a fraction of what it would be if you went to the appraiser without that privately. So the debt to income ratio is, again, something the Bank of Israel is focused on with the banks, and they are looking at how, based on your income, that mortgage and its depending on the structure of the mortgage, because there are new things coming to the market where you're going to be able to adjust. It's not just the adjustable rate adjusting the payment, but you're going to be able to schedule the mortgage payments to change over a period of years. Let's say you're buying a property and you're buying it on paper. So what they're looking at, they're giving you freedom, but what they're looking at also is they're looking at, in the end, when the payment is fully adjusted, or in the case of when you take let's say a 30-year loan, you take a period of interest only. So when the amortization starts, it's no longer a 30-year amortization. It's a shorter amortization, which means it's a higher monthly payment. That's what they're going to look at. They're going to look at the whole picture, and your ability, we'll see later on also with some new regulation that came out about the Bank of Israel Prime, how they're doing that. I mentioned about installment debt. The installment debt, if it is long-term and it is large, like a car loan, then what they're going to do is they're going to look at your net income, again, your monthly after-tax net income, and they're going to deduct these payments that are continuing, and what's left over is basically your spendable or disposable income. That's what they're going to use to do the calculation against your mortgage payment. A loan to values will affect that tolerance, both for the good and for the bad. Somebody who's buying with a 45% loan to value means they're putting a 55% down payment. The bank is going to be willing to stretch those ratios, their debt to income ratios, much more than, let's say, on the opposite extreme, somebody who's buying with a 75% loan to value. Bank's going to be not going to tolerate a certain debt to income ratios they would have with somebody that was buying with a 60% loan to value. For example, if somebody has a 36 or 37% debt to income ratio, meaning the mortgage payment represents 36 or 37% of their net after tax income. In 60% loan to value, sometimes 65, in different scenarios, that could fly. In a 75% loan to value, there has to be unique situations, a guarantor, a profession that shows future higher income, but the bank isn't going to tolerate it, as, if at all, as easily with a 75% loan to value. Now, this is an example of something that's changed. So post 2000, it was 2010, 2011, they introduced this in a couple of phases, but it used to be you can get the entire mortgage as on the Bank of Israel Prime. So it's very cheap, adjustable rate mortgage. One of the first things they did, and they did this actually, as I mentioned, in a couple of stages, they saw that was one of the issues in the US was not being able to, people not understanding and not controlling the fact that a fully adjustable mortgage, their payment can increase significantly. So they limited, and the purpose of the regulation was limiting the use of adjustable. The regulation does not mean that you have to take 3 parts. Now, for the banks, it's actually better. It helps their portfolios be more balanced by taking 3 parts, but the regulation doesn't have any problem with somebody taking a fully fixed rate loan. That the purpose of the regulation is to limit the amount of the adjustable. So initially, and actually until about a week ago, actually less, a few days, the limit of the fully adjustable, something like the Bank of Israel prime rate, was 33%. What they just enacted, they announced it in December. What they just enacted was they allowed that to be doubled. So you still need to have 33% of your overall mortgage amount fixed for the entire term, right? So the balance theoretically can be fully Bank of Israel. However, as we talked about the perceived risk here, if you are doing 66% on a fully adjustable, like a Bank of Israel prime rate basis, they're going to adjust it for risk, which means 2 things. It's going to cost more. It's not going to be as cheap as the previous scenario we saw where it's only 33%. and they're going to underwrite it again. They're going to look at that debt to income ratio in the future and the risks because it can go up, et cetera. So this is very, very new, and it's right now only available for purchases. On February 28th and beyond, it will be this year, it'll be available for refinances as well. Prepayment penalties. Now, if you're familiar in the States, there are prepayment penalties, but for the most part, residential mortgages have very, very short-term prepayment penalties, maybe the first, second, maybe third year. For Canadians, you actually are much more familiar with prepayment penalties. The prepayment penalty in Israel is really, again, this is regulated by the Bank of Israel, and it's because in the 90s, it was the bank's choice. It was much more severe. So Bank of Israel basically is saying that if the bank loses money by you refinancing, because you're refinancing at a lower interest rate, then there's a formula where they can recap. Again, this is talking about the fixed rate portions. So that third of your mortgage that needs to be fixed for the entire term, that's really where it's most important. Because even if you have a 30-year mortgage, but it's adjustable every 5 years, that 5-year period is the only period that counts with that prepayment. And if you're 3 years or 4 years into a 5-year period, then it's only that year period that they're looking at. So it's significantly less. But that term, the whatever period, however much of the mortgage you got for fixed for the full term, that's where it really can make a significant difference. And sometimes it's not worthwhile refinancing because of the effect of the cost of the money can have. If you end up selling the property 10 years later, right? And let's say you refinanced and you had another 20 years left on the loan, and you sell it and you pay it off after 10 years, your effective interest rate is significantly higher. And in most cases, it would have been worthwhile to refinance. But it's something that you have to keep in mind because those prepayment penalties make a difference when the mortgage that you have, right, is higher than whatever the index is in the market that they're following. Now, whether you're from America, Canada, we borrow in nominal terms. You get a mortgage, if it's fixed rate, it's fixed. You get what you start with, right? You end with, and you know what that interest rate is. Real interest, if you're in the investment field, if you're an economist, you understand what real interest is. Real interest is when you're standing from the point of view of an investor, and the interest that you're getting, you want to know what is it after inflation. Because if you're getting a high interest but inflation is higher, you're actually losing money. So one of the reasons why inflation-linked or kavua tzemud lamadad is so popular in Israel, again, as I mentioned, before 1990, it was all government money. And if anybody's the 70s and 80s, Israel had hyper triple-digit inflation. So everything, all mortgages were linked to inflation, but so is everything else. Back then, everybody's income was linked to inflation. So that is something that many people are not familiar with. So I just want to touch on that in a second. The nominal, which is what we're used to, let's say in US mortgages, right? You see what you get, you know your cost of money, right? With a interest rate that's linked to inflation, I believe, I mentioned this to the Bank of Israel once, in America, it would not be legal to say a fixed rate that is linked to inflation. You can't say kavua tzemud lamadad, because the minute you say fixed, people think that it's a fixed rate. In effect, it's an adjustable rate that adjusts every month, where inflation is the index and the fixed interest, quote unquote, is the margin. Let's just see what that looks like. So the first year, Bank of Israel, this is actually the 1.4, it's what the Bank of Israel today is projecting inflation for 2021. So today, let's say you get a mortgage, and there's two different mortgages. You can get a inflation-linked tzemud lamadad at 2.75, and it looks very good, right? And And that's the way it's sold, and that's the way it's described, because people look at Hatzmada as something else, right? Versus the fixed rate that's not Samud, seems like it's higher, right? Because it's 3.5. But when you would factor in inflation, right now we're talking the first year, you see the difference. Now, again, this is an approximation because it's calculated on a monthly basis. But the point is that Hatzmada, the inflation, is still a nominal cost to the borrower. Now, this is the first year. What happens in the future, right? It's not out of the question, and a lot of people are expecting it, that in so many years from now, 5, 10, who knows, inflation could be 2.5% or above. So that 2.75 mortgage is now much higher than it was before. So the 3.5 isn't affected at all by inflation because it's not linked. So again, it is that even though it's a fixed rate, Samud Lamadad, you're still exposed to interest rate / inflation risk. Now, everybody is living in Israel with something, or they're from overseas, or they have expenses overseas. We all learn very quickly what it's like to live in with multiple currencies, especially with what's gone on recently with the strength of the shekel versus the dollar. So using a mortgage to hedge is not a financial gamble, or it shouldn't be used for anything other than hedging for either monthly payments or prepayment principal. So examples of this, you have, you're basically paying your mortgage from income that you earn in the US, Canada, or wherever, right? You have money in an account that you're using in dollars that you're using to make monthly payments, or you have in mind that you want to make a principal reduction in the future. You have a lump sum that you expect in the future, whether it's a Keren Ishtalmut, or you got an Uncle Yossi who's 119 years old, very wealthy. You're his favorite niece or nephew, and he dodges trains, right, for a hobby. So you know that you're going to be getting income, you're going to get a lump of cash in the future, and you want to put that against your mortgage. So if that's in dollars and your mortgage is in shekels, it may not be paying off as much as you want. So by taking that part of the mortgage linked to the dollar or in dollars, you can hedge it so that you know that money you get, you should live long, will be able to pay off what you intend. Let's talk a little bit about what multiple parts and what are the reasons for designing. And again, I'm giving you a high level because there's a lot of different possibilities here, but this is an example of where you're borrowing 1 million shekels. So you're going to take 750 of it in a fixed rate for the entire period, not samud, right? Because you want to be prudent, and you don't want to expose yourself to interest rate risk, and you don't have any plans of selling it in the near term. The dollar portion is, again, because you're hedging income that you're making from the States, and at least that part of the mortgage, you know your dollar is always going to be at par and could be able to sort of stay with that payment, or you have plans in the future of paying that down with with other dollar funds. Again, the scenarios here are endless, but just give you another scenario where you can have 3 different parts, each one for a different reason, right? So that 5-year, if somebody is they have a Keren Ishtalmut, and when that comes due, they want to put that against their mortgage. That's an example of taking a 5-year, right? You take a 5-year because you don't have any prepayment issues, and you will get a lower interest rate than what you get on the 30 years. But again, these are just a few scenarios. You could see there's a lot of possibilities how you can design the mortgage, given the fact that it could have multiple parts. And it's not just 3, it could have 10 parts if you want, or it could have 2. Question, how do you make payments, right, when effectively each part is like its own mortgage. So everything is direct debit. So the fact is that you're only seeing one mortgage payment. That's what's being taken from your account same day of the month, whether it's the 1st, 10th, or 15th, right? When it's broken down, right, you could see online, or at the end of the year, you get a summary, you could see how each part generated a certain amount of that overall payment. Other things that are worth noting: your credit report, you're from the US, you're from Canada, you're from the UK, wherever you're from, depending on how long you've been here, if you've been here, if you have income in the States or assets, it doesn't matter how long you've been, they're going to want to see that. But usually 10 years with some activity in the US, or even if you're here less than 5 years, they're going to want to see your US, both your credit score and your credit report. And unlike in the US, where you need the 3 bureaus, Experian, TransUnion, and Equifax, they get a report where they see all 3. Here, they just need one of the credit reports. And in the US now, there are about 5 or 6 different variations of credit scores. You have a Israeli credit report as well. It's actually, I didn't go into that much detail in my bio, but I was involved in helping that get off the ground. They will pull that as well. They're going to ask your permission for that. Again, in America, the next question is actually illegal, but I have to ask people what their age is. And in America, that's literally a question that's illegal to ask. Israel copied it from the UK. In the UK, they have this mortgage life policy. We'll see that in a second. And because of that, they want the mortgage to be fully paid off by the age of 75. So in Israel, you can go to 80, and there are ways to play with that if there's children, etc. But for the quick and dirty calculation you want to make, you take the number 80, deduct your age, and the remainder up to 30 becomes your maximum period that you can get the amortization for. Just a quick note, everybody calls it Spitzer, Luach Spitzer. So that's not a technical term. There was a guy, Mr. Spitzer, who worked in the Otsar, that back in the day, before everybody had a laptop, calculator, or smartphone, he did the calculations on a table, right? And it became known as Luach Spitzer. Again, there's a period, the government was the source of mortgages. But just a side note, where the Luach Spitzer term, that's the amortization term used in Israel, where that comes from. Title. Now, title issues, and again, Yair's not paying me or anything, but they work hard. In America, you have lot, block, and track, and you have title insurance, so it doesn't matter because the title company takes care of everything, right? The lawyers are doing something on it's East Coast. You have lawyers on the West, on the Midwest and West Coast. You have escrow officers, because the title insurance company is handling the reconveyance, meaning the seller's mortgage, taking that off and putting the new mortgage on. They're taking responsibility for all that, and they're giving everybody a financial guarantee that they're going to do that. So nobody sees that. That's behind the scenes. In Israel, it's work, right? And it's basically done between the attorney and the client, and a mortgage broker like myself assists in getting that done and making sure it's taken care of. Depending on the type of property, and I'll actually leave this for you to go into more detail in the Q&A, depending on the type of property, there's a lot of different types of title. Some of those titles, the banks are more nervous about, and they could reduce the LTV. Property insurance, just like the States, you need to get replacement cost, and that's what the bank requires, and they take a pledge on that, meaning that if you don't renew it, they have the right to renew it, and if, God forbid, anything happens, they are an insured. Mortgage life policies, as I mentioned, are something that the Israeli market, this has nothing to do with the Bank of Israel. This is the banks just adopted. This is the minhag hamokum, so to speak. They adopted this practice from the UK. And basically what it means is that each borrower gets a life policy that the benefit of that policy, meaning the amount that is insured, is the original mortgage balance. And a mortgage life policy versus a regular life policy reduces that benefit every year following the amortization table and the interest rate of the mortgage itself. So that when you get it, let's say you get that million shekels, after 15 years, it's not going to be a million shekels anymore, right? So that's required. There are exceptions. Somebody's older and it's very expensive. Somebody has a health condition, it's a very expensive policy. There are ways where that can get waived. But if somebody's healthy, especially if they're young, it's something that everybody wants to see. The Misrata Shikun. Now, there's a lot of changes going on there. So I won't go into the Mishtakain has been discontinued unless you're in it already. There are a number of programs that they have in the works. There are, beyond the Zakaut, there are still areas where you can get additional benefits, but for the most people, if you're just talking about the Zakaut, you're not talking about the additional benefits that relate to either certain areas or certain nechlus, in other words, a segment of the population they want to assist. So if you're just talking about that Zakaut, your maximum, right, is, it's a little over 300,000 if both spouses have been in the army and their families have been in the army. It's a point system. But if you're buying a 2 million shekel property, then it's really not having an effect on the loan to value or any of the other issues. What they did do, and this is actually only a couple of years ago, they did set the interest so that it'll always be 0.5% less. But keep in mind, they're only doing kvuat tzemud lamadad. So you're talking about that they'll only do a mortgage with real interest. Quick overview. The loan to values can be 50 to 75%, depending on your citizenship, how many properties you own. You have to remember that qualifying for the 75% is more stringent. The interest rate, you have an ability to create a mortgage that is, again, like a reverse investment portfolio that meets your needs within limitations of the regulation limiting the adjustment rates. Age does affect the amortization. The amortization cannot be more than 30 years. And the Ministry of the Construction and Housing, Misrata Shikun, has a number of benefits that actually I think there's some more coming out, albeit for a limited number of people. Again, if you have any questions, please feel free to reach out even afterwards. And if you'd email me, I will be happy to give you, depending on your factors, age, et cetera, and so forth, a summarized list that's pertinent to you from everything we went through. And also there's a very brief vocabulary with English, Hebrew, and transliteration for those of you that want. Josh, I'm going to give it back to you.
Wow, that was certainly thorough. As Moshe said, lawyers in Israel work very hard. Yair's no less. He motored through 30 plus questions of various levels of detail. Actually, I figured we'd have 25 questions sitting here right now waiting for us to answer. And we're down to 3. One of which is, can we share Moshe's email? I will include Moshe and Yair's email addresses in the email that goes out with the recording and all the contents of this presentation. Also, it's right here on the screen as you see. And then Moshe, there's a couple last questions. I'll ask them verbally to you, and you can
Sure.
respond. First one is, for a couple, will they take the median age between the two spouses, 62-year-old and a 70-year-old, to come up with the length of the mortgage?
Yes, they will. There is a factor of who is the primary earner. In other words, if there is, if one has significant income, the other has no income, it may affect it, but they will look at both.
Here's a common question that pops up. Quick answer: are there banks in the U.S. that will provide a mortgage for a home in Israel?
Not yet. Working on it, but not yet.
And can you outline the Aliyah benefits as they relate to mortgages?
I think we sort of covered that on the Zakaut. There is a lot more, and I'm actually working with somebody in Misrad Shikun to do a really complete review of that. If you're willing to go out to certain areas, there are benefits beyond the Zakaut. But if you'd like to email me, I can go into more detail. And I'm actually waiting for there's been some significant changes, and there's some things coming out. So if that person would like to email me, I'll be happy to come back to them with more detail as I get it as well.
Okay, here's the question I'll take. Do Olim get any cash benefits? The answer to that question is there's a whole basket of Olim benefits. One of them for new Olim arriving, not necessarily in relation directly to mortgages, is something called Sal Klita, which is based on a number of different factors, a number of people in the family. If you just Google Nefesh B'Nefesh Sal Klita calculator, excuse me, we have actually a calculator on our website that will tell you how much you can expect to get. It lasts for 7 months, with the first payment coming in cash at the airport. They do that purposely so that you have to open a bank account. In order to receive the rest of the Sal Klita, you have to open a bank account and give the information to Mr. Klita. There's more details on our website. There are no cash benefits for mortgages. Had a follow-up question. Question: given that the mortgage period is limited by your age, why would the bank also require life insurance?
That's a great question. And again, if anybody's on the call from England, this is something that Israel copied from the English market. And in all due respect to the market we have in America, they've actually been around longer. So I honestly don't know the answer to that. I've asked that. I don't know why they do it in England. The reason they do it in Israel is because they copied it from the UK. Ironically, when they do waive it, they get basically affidavits signed by the people. Why? Because they have been sued when they've waived it. The banks have been sued by heirs that said, well, why didn't you force our parents to get life insurance? So.
All right, well, we have now completed our session. We answered all the questions, I think. Thank you, Yair, for your hard work in the background. Thank you, Moshe, for your time and expertise. As I said, we will be sending out a recording of this session along with the PowerPoint presentation, the contact information for Moshe and for Yair. Thank you for joining us, and have a great evening.